Good morning, good afternoon, good evening, depending where you are on the planet, and welcome to the Tuesday, 21st of January, Bull versus Bear webinar. Steve Miley here on the Call for Trade Day. Welcome, everyone. We're going to go for our kind of Monday run through. Even though it's a Tuesday, we've got a kind of a synthetic Monday today, being as the market was pseudo closed yesterday. So cash and bond markets, cash, bond, and equity markets. So the bond and equity markets, cash versions were closed. We had partial hours on the futures yesterday. So markets effectively closed yesterday. You couldn't trade cash equities or cash bonds. So we're going to go for our kind of slightly bigger picture run through today. I just wanted to double check though that you can see as you can hear me, because I know the last webinar Duncan did at the end of last week, there was an issue on sound. I'm hoping that the sound is all okay on this. You can hear me okay, guys? Can I get a yes on that if you can hear me? Well, I'm going to carry on. I'm hoping we're going to get some yeses coming through that you can hear me okay. So we basically had that Martin Luther King Jr. Day holiday yesterday. So we're going to take a look at our kind of slightly bigger picture for the week outlook going into today. So, I sound all good, brilliant. Okay, thank you guys. Thank you, Stephanie, Ben, and Jim. So, we'll go through our macro. Well, I'm not going to go through the macro matters. Remember, the macro matters is the longer version. You can get this below where you are. There's an unlikely pair to be next to each other, right? You can get this below where you are viewing this now. If you go take a look, we had three columns of research. The left-hand column is the technical analysis. You get that on a daily basis, 5 days a week during the trading day. So technical analysis on the left-hand column. Middle column is where we publish our weekly, comes out of the weekend. The macro matters, which is this, what you see in front of you, the longer version, looking back to what were the main points from last week and what we have looking forward to going into this week. And then we have our macro summary, which I'm going to run through in here today. This is just a summary of what you see here in the macro matters. So if we go through the summary, last week the stocks were up significantly, helped by lower yields. So bonds were up in price along with stocks. So stocks and bonds up in price, yields lower, and those lower yields helping stocks higher. The main driving force of those lower yields and of the higher stock indices was the CPI data last week, which was significantly better than expected. And so that gave some cheer to the markets that better than expected inflation moving the right way. Maybe that puts the Fed in a position of maybe moving interest rates lower. Remember, we're only now expecting 2 rate cuts at most now in 2025. So that's maybe increased the chance of maybe the Fed being a little bit more dovish. And obviously, lower inflation is positive anyway for the economy. Major US banks as well reported last week. The earnings season really kicked off in earnest last week with the banks and the financials. Generally, they were better than expected, surging profits for many of the major US and global banks, investment banks. And so we saw a broad move higher in the financial sector, and that helped the broader market higher as well, alongside that December CPI data. As we said, yesterday was the Martin Luther King Jr. holiday, so markets closed. It happened to coincide with the inauguration of President Trump, and we'll take a little bit of a look at that as we go forward and what happened yesterday or what's happened in the last 24 hours. Going into this week, on the macro side, we have global flash PMI. So flash PMI, remember that's the early release PMI data for January. January's not over yet, but we get this early release from S&P Global. So we get the early release S&P Global data for the major global economies in here coming out on Friday. That's the real main macro data for the week. We have a host of earnings data, with the standout really being Netflix that we get today, but not till after the bell. So basically, last week we saw equities higher, European and US bond yields significantly lower. The US dollar corrected lower and then rebounded last week. Gold futures rallied near to the top of a multi-week range, near to the all-time high, and oil also to a multi-month high last week. As we said in here, on the geopolitical side, Monday's already gone. We've had the inauguration. On the central bank side, it's fairly light. PBO interest rate decision already didn't really impact And then we get the Bank of Japan interest rate change monetary statement on Friday. Again, not expecting too many fireworks from that. On the macro data side, we said global PMI is the main focus. We also get Canadian and Japanese CPI Tuesday and Friday, respectively, watching out for those. And the main the Q4 earnings season release is Netflix today, but we also get Procter & Gamble, Johnson & Johnson Wednesday, Texas Instruments and GE Thursday, Verizon on Friday. And you can see all of these in the table in here. So those are the main to note in here. As I say, on the data side, it's fairly light on the actual US side. Nothing of real note today in here or tomorrow. Nothing of note from the US anyway going into today or tomorrow. Nothing really from the US on Wednesday even. Then we get that global flash PMI data. So that's going to be the main focus for the week. And we can see here on the earnings calendar, Netflix is the standout one today after the bell. So not till after the close. So if you trade the later session, you may pick up some volatility. That might also obviously get some volatility. And we'll talk about the Trump inauguration and already having signed in some executive orders that have seen particularly FX markets chopping and also equity markets chopping recently over the last 24 hours, particularly the FX markets moving notably around, but stocks in here chopped lower in the partial session, the futures market down, then back up again. Going into tomorrow, as we said, Procter & Gamble, Johnson & Johnson, Abbott Labs, all on Wednesday. Thursday, we're looking at Intuitive Surgical, GE on Thursday, Texas Instruments, and then Friday, Verizon, probably the standout there. So a host of earnings data coming through the week. As we said in here, nothing really of note in here. Looking on the calendar, we've had some European stuff, German ZEW data, but not massive. Some UK unemployment report in here this morning, but again, it's not really impacting into the markets we're looking at. Canadian CPI might give a clue. It is a big trading partner of the US, so maybe watching that, it might give a little move to markets, but probably not expecting much from this data today. The other thing to remember is we're now on the blackout period. So so the Fed in here. We have the meeting in here next week on Tuesday, Wednesday, 28th, 29th. So a week and a half before that, the Fed always enters its blackout period. So we get no news from the Fed from this weekend just gone. All of this week and the first half of next week, no news out from the Fed, no Fed speaker, so no clues from the Fed. Let's take a look at what we've got on the morning briefing Americas in here from Bloomberg. The main focus in here is on Trump and kickstarting his presidency barrage of executive orders. Expectations that Mexico and Canada are going to get tariffs of 25%. Those expectations are by the 1st of February. So within a week or so, self-proclaimed tariff man may be holding off. It said, look here, Mexico and Canada by Feb 1. Spared China for now, ordered a probe into Beijing's compliance with a deal struck during his first term. So a probe into China. And rollercoaster riding markets in here with traders zeroing in on a warning over currency manipulation. So that's got the FX markets moving in here. Crypto in here, we've seen markets, Bitcoin pulled back from the highs. No new news on crypto, nothing from crypto. And the crypto market is has been rising recently on expectation of a positive crypto outlook from Trump. And we did not really had anything from that. Bad news for Apple in here. iPhone sales down 18.2% in China. So overnight in here, this is separate from anything to do with Trump. So that's definitely been a negative in here on the overnights. So a load of headlines on Trump. A rundown of Trump's executive actions from tariffs to immigration. I'm going to post this. If you do have a Bloomberg, I would suggest you can buy a Bloomberg. Subscription in here for relatively cheap these days. It's a couple of dollars a month, I think. So if you can, maybe subscribe to the Bloomberg subscription in here, and this just runs through all the things. Basically, put a temporary halt on a ban on TikTok in the US, tariffs in here, etc., etc. I'm not going to go through everything. Pardoned nearly everyone who's involved in the uprising at the end of his last term. In here, Trump holds off an immediate China tariffs, calls for study. So that's kind of a positive, holding off on those. Z dodges early Trump tariffs, buying China at a time to influence the US. Republicans skip meeting to plan to punish Beijing. Likely short-lived as tensions linger on exports. There's the thing on Apple. Apple's iPhone sales. That's very aside to Trump. nothing to do with Trump in here. Trump's tariff shifts are a warning for corporate America to expect whiplash. Yeah, I mean, definitely. I mean, I don't know how many of you were trading back in the day when Trump was last president, but when he was, markets were far more volatile on a day-to-day basis, far more volatility. That can be good for day traders. It can, depending on your style of trading. But you have to just be careful, because you can be in a trade and all of a sudden it just jumps against you, or maybe for you. But from him just tweeting something, and that happened a lot. He also tends to tweet at the end of the US day, sometimes in the hour when the US markets are closed, the futures markets are closed, often after the US equity markets are closed. So the markets can be less liquid, and so you get a lot of volatility in that evening session and overnight. He's a bit of a night owl, is Trump, and we often got tweets, very, very, very late in the US day, getting on close to midnight sometimes, 10, 11, 12 p.m. US time, when Trump was putting out tweets, and, all of a sudden markets are jumping around when there's less liquidity. Excuse me. Sorry. So, just to forewarn you of that going forward. That's the same article. And stocks rise. They did dip lower and rebounded. S&P futures slightly higher in here, as jitters on tariff threats subside. So those concerns around tariffs. Mexican peso and Canadian dollar hit hardest by tariff threat. No surprises there, really. But nevertheless, markets kind of, so far on the equity side, we saw, say, sell off and rebound. In the kind of partial hours that we had yesterday. Remember, the cash market was closed. It's going to be interesting to see how the cash market reacts when it opens in the next couple of hours. So here, switching to Reuters, stop go Trump tariff trade whiplash dollar. So the dollar's been rather rebound sharply after a significant setback in here, and futures up as Trump 2.0 jolts the markets. And if you look on the overnights in here, you see Asian markets, Nikkei is up 0.3. Hang Seng, China-related market in here, actually up 1% in here. A bit of relief in here, the fact that China's so far avoiding any tariffs. Unchanged in here on the UK FTSE pretty much, and also the German DAX only slightly down. European exchanges fairly unchanged overnight so far. And if you look at the US futures, we're up slightly. So a slight push higher. We had that whipsaw session yesterday, down and back up again. About 1/3% up across the board for the major US equity indices. Let's turn our attention to the interest rate markets. Well, remember, we've got the meeting next week. Zero chance of a rate cut, pretty much. Well, a 0.5% chance of a rate cut priced in. So very, very little chance of any rate cut. We're obviously going to look at next week at the statement and the press conference to see if we can get any clues about when the Fed are thinking about moving on rates. But the market is now pricing in like June. So we go all the way. Remember, the rates are current target rate is 425 to 450 here. There it is there, current target rate. And that's what we're pricing in after this meeting next week. If we go all the way out to May, though, you can see, look, 425 to 450. There's a 50-50 chance we're still, by May, we're still at 425 to 450. So 50-50 chance. By March, by the way, pretty much no chance. Only less than a 30% chance. You see 71% chance we're still at 425, 450. So maybe a rate cut, 50-50 by May. By June, we're expecting a rate cut. Only a 32% chance we're still at rates where they are now at June. So May, June is that's where we're expecting the rate cut to come. If we go back into the back end of the year now, October, you can see we're priced in pretty much. There's only an 18% chance we're still unchanged in October. But now we're expecting there's a 50-50 chance by October that we'll get more than one rate cut. So in here, we're expecting potentially more than one rate cut. If you add all these up, it's about 50% in here. 50% chance, roughly, just under 50% chance. And by the end of the year, if you add these, you've got 48%, 49%. So 50-50 by the end of a year for another rate cut. So we're looking at May, June, really, for the first rate cut, and then maybe another rate cut by in either October, December. That's all the market's pricing in. Only 2 rate cuts for this year. My view is that we could pivot towards inflation getting better if Trump's policies, if the Trump administration is a little more gradual on its tariff. If it goes hard on tariffs, it can cause inflationary pressures. The Fed will be in wait and see mode. They won't want to act too aggressively if we see aggressive tariffs, because that can then down the line push inflation higher, and they will not want to be cutting rates in that scenario. If we have a kind of gradual move on tariffs from Trump, a more gradual approach, a less kind of aggressive approach on tariffs and just generally in here. If he doesn't overstimulate the economy, then there's more likely that then the Fed might pivot towards more dovish, and then the markets will probably like that. Okay, so it all depends on how aggressive the Trump administration is in imposing tariffs and in stimulating the economy. And then if we look at this is helping though. Since CPI data. That day this is the bond market by the way, US 10-year yields. So remember, down in yields is up in price. So yields going lower, lower yields are positive for stocks in it. And you can see we almost got that. So we backed off from just above 4.75% in here on yields after CPI, a significant drop in US 10-year yields. We've held above this little swing low in here. So that low there is basically at 450. And we kind of went down towards there on the overnights today, and then we're back up to higher yields. If we can break below like 450 to what's that number there? 449, 450 to 449% below there could open up significantly lower yields, and that should be supportive of stocks. And if we look at it on the bond markets across the board area, and the bond markets 30-year, 10-year, 5-year, 2-year, you can download this report. Remember, below where we are, we're pushing up towards some important levels in here. So these kind of swing highs, these are the equivalent levels here. This 102.28 and a half on the 2-year note, up here 106.18 2 in here on the 5-year, etc., etc. You see these important swing highs in here. These are all the equivalent levels as I just highlighted there on the 10-year yield. So that 450 to 449, the equivalent here on the 10-year is this swing high here, 109.06. We can take 109.06 here in the future. So maybe go mark these levels in here across the board, 30-year, 10-year, 5-year, 2-year. These swing highs that we had it's early January, right? These are all from early January. Okay, pick out these swing highs. I would mark them on your charts, right? Even if you're trading equity indices, because we take out those levels in here, it means bonds are probably going to push higher prices, lower yields, and that should be supportive, and you might see an acceleration on the equity markets. So I've been marking these levels in here, that these swing highs from early January across the board, 2 years, 5 years, 30 years, 10 years. Even if you're trading stock indices, mark those on your charts, set alerts on those, because if they trigger, then we're likely to see stocks go significantly higher. Stocks stay bullish in here. We had a dip and a strong rebound yesterday. We'll look a little bit more depth in a second in here, but S&P 500 and NASDAQ both looking more bullish, both taking out these trend lines. I've got these on my charts. We'll look at those in a second, but these down trend lines, we've taken those out over the last week or so, and now using those old trend lines as supports. And now we've got a succession of higher highs and higher lows, so pointing higher on both the NASDAQ and the S&P. And we can see those here. So NASDAQ in here, look, you see that big dip and a rebound in here on the partial day yesterday. Big sell-off, big rebound in here around Trump. That's on the ES, on the March contract. NASDAQ, same sort of things. Big sell-off, big rebound in here. A robust rejection of the downside. And these are the downtrend lines that come down through there and down through there. I've got them on the 30-minute chart. So we go into the NASDAQ now. You've got these downtrend lines. So these are the same trend lines that I've got on my analysis here. Okay, these dotted down lines in here that we've got on both the ES and the NASDAQ. And you can see them here on the NASDAQ. We're through that trend line. You can see kind of now using the underside of those trend lines as support in here. And if I go to the ES, it's the same thing. Here on the 30-minute chart, here's the down trend line up through that using the underside. Look, we spiked right down to that old trend line. And now we've got these uptrend lines. We've got the higher highs and higher lows, higher highs and higher lows. We've got these kind of quite accelerated uptrend lines in here providing support on both the NASDAQ and the ES. Yesterday, we pierced down through that uptrend line, but then rebounding off of it in here overnight and this morning. So holding this support trend line that comes up in here from the middle of January. So these support trend lines now holding and having reversed up above these down trend lines. All the threat for me remains to the upside going into today. All right, guys, I'm going to leave it there. I'm going to wish you all a great trading day. Take care, stay safe, and I'll be back with you with another Bull versus Bear webinar on Wednesday. Bye.